Hey everyone, happy Friday to you. It's time for Advanced Options Strategies. Today I wanted to cover a strategy that I think a lot of people would consider kind of a stock replacement type strategy, and that is back ratio spread. So we're going to do that today. But before we do that, let me just welcome you, whether you're watching live or on a recording. I see some familiar names. I'm also joined by Barb Armstrong, who is a wonderful instructor and friend, and glad to have her helping me out here. So as you have questions, feel free to type those in the chat. Between Barb and myself, we'll do our best to help you out. Excuse me. You can also follow us on X, formerly known as Twitter, at Brentmore CS, at Barb Armstrong CS. Now, I do need to go through a few disclosures before we get started. Remember that options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation or endorsement of any particular security, strategy, or chart type. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money application is for educational purposes only. You will be using the Thinkorswim desktop software today. I don't always factor in commissions here in our trades, but realize that's something for you to consider, our commissions and fees and whatnot. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And, that's a factor, and that's going to be a factor in the trades that we do today, because we will be using short options today in those. So today, we're going to, first I want to cover kind of the basics of back ratio spreads, and then I want to kind of discuss back ratio spreads in the context of some example trades there. So that's how I think is a great way to learn it, is to actually use potential trades there. But before I get too far into this, I just want to, I mentioned the word stock replacement strategy, and let me tell you, I want to kind of start off with what I mean by that. I'm going to look at Citigroup here, and with the technical posture of a general trend that's been up. We've held that 50-day moving average. We tested it a few days ago, but in general, I'm going to consider this an upward trend and a potential support line where our gap is right here. So that's kind of the technical stance I'm taking on this as more of a bullish trade. And if I wanted to, I could go and I could buy 100 shares of Citigroup. And, if I do that, this is kind of what our risk profile looks like. Now, if you are not familiar with this risk profile, I'll try and go through some today, but I went through a whole last week, I did a whole thing on the risk profile tool. I put a link to in the chat you may have to scroll up to the top of the chat to the playlist for this webcast. Or if you're on YouTube, go to the playlist for the Trader Talk Schwab channel, and you can get the playlist for this class. Last week's class, I go through a trader risk profile tutorial. But briefly, at least, this is showing profits or losses a given stock price down here on the x-axis, and you can see the more this, how this works. It's a stock, for crying out loud. The more the stock goes up, the more money you make. The more the stock goes down, the more money you lose. That's what the stock looks like. The delta on 100 shares of stock is going to be, depends on how you express it, 1, okay, or 100, delta 100. In other words, if 100 shares of stock, if the stock goes up $1, you make $100. If it goes down $1, you lose $100. Okay, so that's what that is. And now, there's a theoretically unlimited gain on a stock. The higher the stock goes up, the more money you make. Now, I don't think Citigroup is probably going up to $1 million in the next few days, but I guess you never know. What's our loss on the stock? Well, you can lose everything you put into the stock. In this case, it's a $78 stock. That'd be $7,800 for 100 shares, and you could lose that all. You lose more and more that it goes down. So I just want to start off with that as we consider Citigroup here, because I want to next talk about this strategy that I talked about in terms of that I mentioned, and that's a back ratio spread. Remember, that's not the right stock. Let's go to Citigroup. Remember, in terms of this, in fact, let me link this so that I'm not switching back and forth all the time. On Citigroup, 100 shares of stock was going to cost us about $7,800, roughly. Okay. So what's a back ratio spread? A back ratio spread is, it's kind of like a vertical spread, except we're going to do an unequal number of long options and short options. So a back ratio spread, we're going to do typically one short option or some multiple thereof, and two long options or some multiple thereof. So ultimately we could do 2 short and 4 long, 3 short, 6 long. You get the picture on that. Okay. Now, the way I'm going to do it today, and George kind of jumped the gun on me here in the chat. For those of you who look in the chat, George mentioned something called, he said a zebra. Okay. So the way, not all back ratio spreads are necessarily zebra trades. What's zebra? Well, zebra, Z-E-B-R, this is how they come up with their name, stands for zero extrinsic, I'm going to abbreviate, back ratio. Okay. So we're going to get to that in a sec here. But, you know, there's a lot of different ways you're going to do them. You can do them. You could do them out of the money. You can do them in the money. You can do them at the money. But what I'm going to do a short contract that is at the money. And I'm going to do 2 long contracts that are, in the money. That's supposed to be an I there. I kind of mangled that I. And so ours actually are going to look a lot more like a zebra, okay, trade, a zero X, and I'll show you more on that in just a second in case that didn't make sense. What does zero extrinsic back ratio mean, okay? What I want you to know to start though is this. Back ratio spread, kind of like a vertical, same expiration date, different number of short options and long options. And in the case of a back ratio spread, more long options than short options. I'm not going to talk about it today, but front ratio spreads, we're going to reverse that. We're going to do more short options than long options. Okay. So that's how we're going to do that. That's that zebra that George mentioned in the chat there if you're watching live. And if you're not, well, there's zebra for you. So basically what this is saying is, well, let's do this. Let's take a look here and let me get out of my drawing tool. And for our purposes here on this trade, for this example trade, again, I'm going to go bullish. I'm going to go out. Why is that there? Okay. I'm going to go out to the March expirations, 21 days to go. And remember how I said we're going to build this. We're going to build this with one at the money. Stock's at about 78.40. So I'll say 78. I'm going to go to calls and I'm going to sell that. I'm just going to click on that. Okay. Let me put this down here. Okay. Now, you can do calls or puts on these. For our purposes, calls, for the way I'm showing you today, calls are bullish. Puts are going to be a bearish spread, and I'll give you another example with a bearish spread. Now, if we wanted to, we could, instead of doing a back ratio spread, we could just buy some call options, and that would be quite bullish here. I'm going to go in the money, though I mentioned that already. We're going to go in the money for our long options. But in terms of picking a long option, Here's where that zero extrinsic value kind of comes in. I have a column here that says extrinsic value. If you don't have that, you can add it right here on your menu. I don't know what yours says right now, but you can change that and put up extrinsic value. Here's my extrinsic value on this, and the number may move as we talk here. But keep in mind, extrinsic value is that element of the option that will decay with time. That will decay with time. Come expiration, there's no extrinsic value left on that trade. Well, for the long option, and if I do two of those long options, what I'm going to try and do is where the name at zero extrinsic value means my short options extrinsic value is going to basically equal my long option. Okay, so my short option has about 230. It's not going to be exact, but I have two of these. I have two of these 74s. Okay, so I'm going to go 2 times 105 is going to be about 210. Not exactly, but roughly. This is roughly 1/2 the amount of this because I'm doing 2 times this number of contracts as I am doing of this one. Okay, any mistake on that? Any mistake on that? Not mistake. Any questions on that? Sorry, I got distracted there for a sec. Any questions on it? So our extrinsic value, we're shooting for about twice this is what we have here because we have more contracts here. And remember, in terms of time decay, short options are going to benefit us in terms of time decay. Long options are going to work against us on time decay. Theta works against us on those. So we're kind of equalizing those out. Now, I don't want you to get too caught up with the specifics of exactly necessarily doing this zero extrinsic value thing, but I just want you to realize this is probably a good place to start in terms of back ratio spreads. And you can tweak the prices up or down. You can tweak those strike prices. You can tweak the expiration dates if you want here. But this is what I want to show you is if I do this trade, and I forgot what I clicked on the 78 already. We're going to click on the 74, and these are going to be calls. So I'm going to hold down Control key, and I'm going to do 2 of the 74. Now, let me just change this to, come on. Let me just move this so I can actually see my quantity. I want one of my 70, excuse me, I want 2 of my 74. I'm going the wrong way is my problem. I want 1 of my 78s. That's a back ratio spread right there. My at the money call short, 2 of my in the money calls long. Now, let's analyze this trade. Let's just take a look at this on the Analyze tab. So I'm going to click on Analyze. Now, let me just tweak this a little bit so you can maybe see this a little bit better. This is what it looks like. Now, what I want to ask you is this. Remember what the risk profile looked like on a long stock. Remember what it looked like? The risk profile looked kind of like this on a long stock. The more you went up, the more it went up, the more money you would make on a long stock. The more it went down, the more money you would lose on a long stock. Now let me get rid of this and let's look at what the similarities. Well, this looks pretty similar, doesn't it? In terms of if it goes up, we have a potentially this theoretical unlimited gain on the back ratio spread. Okay, if it goes down, it caps us out. There's a max we're going to lose on this. Now that loss may be substantial. In this case, $814, which is the debit, by the way. The debit on this is the cost. Now think about the initial cost on this. In this case, $814. How much when we were doing the stock was it going to cost us? Well, we said the stock was about 78 bucks. It was going to be about $7,800 for the stock on that. Okay. So you can see the price difference there. Now, I'm not saying this is an exact substitute for the stock. Number one, we're going to have some theta, some time decay on this. Number two, this expires on us. This is how far we went. We went out 20, basically 21 days here. We went out 3 weeks here on this. Okay, but can you see when I say this could be kind of considered a stock replacement strategy? This gives you a lot of the upside of the stock when you're doing this. And in terms of when we were looking at this, our delta on this is about 98. In other words, instead of 100, which was for the stock, this is giving us 98 cents on the dollar, so to speak, in terms of movement of that option trade here, there. So does that sound like a possibility? Intriguing, perhaps, maybe, as a way of possibly kind of protecting your loss here? Now, there's a couple other things I want to point out on this graph here. One is this. If you look at this line, it's kind of a straight line we have here going down, meaning we kind of have this linear rate of decline. But then all of a sudden right here, okay, it actually goes down more rapidly. In other words, if this goes against us, we lose money a little bit quicker initially, okay? We lose money quicker initially on the trade, right in that area, but then it caps out. Jim said this is like putting a floor in the trade. Yeah, this is like putting a floor in the trade. Now, we may still look to get out of this trade and exit here on this trade. Now, here's another thing. If it goes up, let's say it is favorable to us. The stock goes up. We move up from, right now we're at about 78.5, and the stock goes up. We participate in those gains on this trade immediately. I mean, they're unrealized gains because we haven't sold out at that point, but you can see the profit loss goes up immediately. Whereas on the downside, this purple line, can you see this purple line right here? This represents today's date, okay? The bluish line represents expiration. So in other words, if it goes against us in this zone that we don't want it to be in, we definitely don't want it to be in this zone, but it actually is a little less penal initially against us than it does if we hold on all the way to the end. So if we decide to get out of this guy, then what we can say is, well, look, it may not be as bad as it looks initially from this blue line, because the time decay element of it isn't totally hurting us at this point on that. So it benefits us on the upside, but on the downside, it actually kind of helps us that there's this decay component here that would work against us on that. Okay, and there's our floor. So let me move this up, and let's go back to the chart here for a sec, okay? And Kola said, is this also called the zebra? Yeah, you may have came in a couple minutes late here, Kola, on that. I kind of explained that to you. This would be, the way we constructed it was kind of a zebra-ish trade there on that. And some of you may have seen, we've done some sessions in the past on zebras in this class. If you go back a few months, not all back ratio spreads are necessarily zebras trades, but this one we've kind of constructed as like a zebra. But here's what I want to do. I want to say, look, yes, this caps us out if it goes against us, but I still may want to put an exit on this. I'm going to call this as a support level, okay? We kind of hit down there. This is the top of the gap, in other words. Top of the gap was right about here, and we have our moving average here. I'm going to do our low here on this day was what, 76.5. I'm going to say if we go below 76, I want to get out of this trade. Okay, so that's a possibility as well. So here's the trade, and I'm going to put in an order to get out if it goes below 76. Right now the stock's at 78.5, and hopefully this works out well for us. We'll see. So let me go and click on this first triggers sequence. Okay, and I'm going to put on an exit order here. I'm going to right click on this and I'm going to create an opposite order to get out. And I'll hit questions up in just a minute here, folks. Okay, so here's my entry trade. Here's my exit trade. And I'm going to make this a market good till canceled. I'm going to go to my gear and I'm going to go right here. Okay. And I'm going to say we're going to get out of this if Citigroup marks less than or equal to, we said 76. Okay. Or if you don't want, you can do some other, you can say, well, maybe I want to give it a little more wiggle room. 75, I don't know, 50. Click save. And I'm going to then confirm and send. And then make sure you read all the red notes there on this and click on send. Okay. Now, let's go back. Let me just answer some questions here on this. I want to go back to that Analyze tab as we do this. Here's our trade that is in. And the question is, can you discuss why one might select this strategy versus a single long call? Well, let's do that. Let me just see if I can, let me see if I can figure out how to do this. Well, let me go to add simulated trades, and I'm going to, just to compare apples to apples, I'm going to do a 74 here. So we're going to go here and we're going to put in a 74 long call, and we're going to then go back to our risk profile. Okay, so looks pretty similar. There's our long call, and notice this zebra trade is actually going to cost us a little more up front on this, 814 versus 550. But when we look at, let's look at this here, okay? Let me, just struggling with space here on this graph. If I look down here, I can see, remember, the whole purpose, one of the things was this was a zero extrinsic value trade. This is going to have time decay working against gets us from the get-go. So time decay is one of the things that's really going to work against us on this. This is the long call itself is not a zero extrinsic value trade. In this case, if we went in the money to this 74, just to keep apples to apples here, we actually have a full $1 of extrinsic value on there. So that is, in terms of the time decay components, if we hold it for, I mean, if you just hold it for a day or two, it's probably not going to be a big difference. But the longer you hold it, it is going to benefit you from that time decay component there. Now, these are kind of more expensive trades if you compare them just to a long call. But compared to buying the stock, it's a lot cheaper than buying the stock. And the buying power effect here is also, you got to double check that there. Okay. Kevin said, am I correct to think that this is an option version of a stock purchase protective put? Yes, Kevin. Let me finish reading your question before I answer that too. With the obvious exception expiring and having the stock at the end. Yes, this is basically analogous to a married put. Okay. This is analogous to a married put trade in that, very similar, Kevin. And there we go. Okay, good questions. Very good. Now, I mentioned earlier that you can do these bearish as well. So let's look bearish here as well. You can find your bearish trade of choice. Is that bearish? That looks pretty bearish. USB looks pretty bearish. Okay. Let's do BMY. BMY, maybe not super bearish, but we do have a decent resistance level up here that you could use as a start of a bearish trade. But what I'm going to do is I'm going to pull up Merck. Okay. This is one I was looking at earlier today. And why bearish? From a technical standpoint, The answer is why would a trader potentially be bearish on this? I'm not saying it's going to go down or up. I don't know exactly. But from a technical standpoint, the trend has been down. You can see that reflected in our moving averages, although we did creep above our 20-day moving average. This is a potential, I would say, resistance level right here. And by the way, there is a survey link in the chat, everybody. I failed to mention it a few minutes ago, but if you would fill that out, we love your feedback. So just look up a little bit. Barb posted that survey link up there, and we do appreciate that feedback. And you can fill that out at the end of the session if you want to wait on that too. That's no problem. Okay, so trend is down and support and resistance. And you'll hear me say this all the time, probably almost every class I teach, I say something similar to this. In terms of technical analysis, the number one thing that we're going to look at in this class is trend. Probably the number two thing we're going to look at in this class is support and resistance, okay? And so our trend is down, potential resistance, I'm going to say right about in there. So therefore, I'm going to do a bearish trade on here as our example. So let's go back and we're going to do a similar thing here. We're going to go to Merck. Okay. I'll do a different expiration day. We can go out longer. Now, longer is going to cost us more. Okay. That's the downside of longer. The good side of longer is it gives you more time to make more money if it goes your direction. Okay. So let's do it here. I'm going to go out, we'll go to these monthly contracts, and just remember, if you're struggling with liquidity, now we could go out 42 days. I don't need that many strikes out just to show us, okay? Now, one advantage of these weekly contracts is we have strikes every dollar. We probably do not have that, I'm guessing, on the monthly contracts. No, you see we got strikes every $5. So it's not quite as slick in that regard. But spreads are typically better, tighter on these. So on the monthly contracts, $3 by $3.15. On the weekly contracts, $2 by $2.94. That's about 24-cent difference. That's about a 15-cent difference. So they're a little better on these monthly contracts, and that is typical. Okay, these aren't necessarily terrible here, but these are typically going to be a little bit tighter. The advantage of the weekly contracts is, of course, you have more expiration dates you can deal with, right? Look at all these weekly expirations you have, near term at least, and you would typically have more strikes. But let's see if this works out here for us. Now, remember our formula. We're going to go in the money. Okay, we're going to go in the money, and we're going to go at the money. Okay, at the money is going to be our short contract. So I'm going to sell that 90. I'm going to go to the put, and I'm going to just click on the bid price here on that. And I'm going to go, let's look at that extrinsic value. About $3 of extrinsic value. And so remember, I'm going to do two contracts. Oops, going the wrong way. In the money here. I'm going to do two contracts in the money. I did 90 as the money. Technically, the stock's at 91. That's where it may be a little bit nicer to go to those weekly contracts. But it doesn't have to be exactly zero extrinsic value. If we're a true zebra, this may not fit the bill, so to speak. But here I have $2. So if I'm doing two of these contracts, it's still back ratio spread, just not zero extrinsic value. If I went to these weeklies and I went to the 91 and I sold this 325, that means I'd be looking for something like a, what did we say? We said 325, that'd be about $1.60 or so. Then we could do the 96 if we truly wanted to keep that as a zebra. our spreads are getting a little not quite as great here on this one. Okay, in this class, for this class, we typically look for spreads to be 10% or less, and that doesn't really, that's kind of right at 10% or maybe even a little more. So here's what I'm going to do. I'm not going to do the whole zebra thing here on this one exactly, but what I'm going to do is I'm going to, I think I already clicked on it, didn't I? I'm going to sell the at the money contract. I'm going to go in the money, and I'm going to buy 2 of those. Let me hold down my control key. And now notice I kind of went through this quickly before. I tried to change the number of contracts here, but notice if you change one, it changes both of them. So I got to change that from vertical to custom, and then it will let me change these independently. So now I have 2 of the one. This makes it a ratio spread. The fact that it is more long contracts than short contracts makes it a back ratio spread. And I'm going to right click on this. I'm going to analyze the trade. Let me kind of just do this and make this a little bit bigger so that we can see it. I'm going to center this out here. And expiration date we said was the 17th, so I'm okay there. Let me set my slice to break even. Okay, there's my break even. 90, can you read that? 57, I think. 90.57. The current price of the stock is, let's see what we got. 91.09. Okay, so we're just above where our break even is. But this would be kind of analogous to short stock. Okay. Now, one kind of bad thing, can I say the word bad here? Yeah, bad thing about short stock is risk of short stock is there is a theoretical unlimited loss on short stock. If you watch our webcasts, folks, not just my webcast, but Barb's webcast, other webcasts, you're going to see none of us talk that much about just going short on stock, just shorting stock. Okay. And one reason is that theoretical unlimited loss. Okay. So on this one, and that means the higher the stock goes up, the more money you lose. Well, look, this kind of takes care of that. It doesn't take care of all risk, but it takes care of that if you want to do a bearish trade that looks like this. Doesn't matter how much the stock goes up. That's our max loss there, our initial debit here. Let me just change the scale here just a little bit so we can zoom in on this perhaps. There we go. We'll do that. Same issue we had on the other one. It's kind of linear, and our delta on this, it's not quite, delta's about 86, we'll call that. Okay, delta's about 86 right now on that. And that is, it's not exactly like, well, what would the delta on short stock be? Delta on short stock would be -1. Here it's minus 0.86. So not exactly. This is going to be not exactly, but it's going to be close enough to get the same effect that we want. And notice it kind of, the angle kind of changes here. This nice linear line kind of, it gets worse pretty quickly, and then before we hit our floor on there. Okay. Now, and you go, well, if I were to do short stock, I can use a stop loss. Stop losses aren't guaranteed, folks. Keep in mind. Now, the danger on these, one of the dangers on these is that when we consider this trade, we have an at the money short option. Okay. We have an at the money. Let me just bring this trade up here. Here's our options here. This one is at the money. The more in the money it goes, in other words, if the stock goes down, the more in the money it goes, the more likely you are to get an early assignment on that. That's always a risk on these. So just be aware. Now, is it the end of the world? It may not be the end of the world. Remember, if it goes down, say, or let's say we get assigned on the 90 contract, at that point, we still have two long 95s. If we wanted to, we could exercise one. If we did that and we were out of the 90 and we were out of one of the 95s, what would we be left with? Just the long put there. Okay. So that's how that works. Okay. So I think that's what I wanted to say on that. Let me go and let's talk about exits. Again, we may not let this get to a really terrible situation here. Maybe we say the recent bounce we had down, the high price on this candle, which is 93.06. I'm going to give it a little wiggle room. Maybe we'll go all the way up to 95 and say if it goes above 95, we're going to get out that. Okay. So let's look at that. Okay. So let me go here. I'm going to just create an opposite order. I'm going to right click on this, create an opposite order. I'm going to do this to get out, make that good till canceled. I'm going to make this an opposite order. And we're going to say if Merck marks greater than or equal to, and we said 90, we gave it a little wiggle room there, 95, then we're going to look to get out of that trade. Now, just as a reminder on this, if it goes to 95, which is not a great situation, that's right here. But if it goes, the quicker it goes there, the better off we are, because that time decay element will not have kicked in on us yet on that. As well, totally, completely at this point. Now we're still losing money. It's still showing us, what about a $320 loss or something like that on that? Well, it's not a foolproof trade. Obviously, there is risks to that there. Okay. Leon says, it seems like a bearish bet by long in the money puts financed by limiting short. Yeah, this is a bearish bet, correct. These are long in the money puts, correct. And they are partially financed, not all the way financed, right? It's not a zero cost trade like we'd see with the synthetic. Okay. There's going to be a debit there, but yeah, it is partially financed there, Leon there. Now, I mentioned the word synthetic. Just keep in mind, synthetic is, and I'm not going to go into it now, we have other sessions on synthetics, but we could do a synthetic, what we call a short synthetic, by buying a long put, and doing a short call at the same time. And our initial debit on that may be 0 or something like that, but that doesn't mean that's your risk, right? Don't confuse initial cost with either buying power or risk on these. Okay, those are different things. Let me get out of this here, and let me go back to our trade tab, and I'm going to confirm and send. And our buying power effect, $870. Okay, if you were to, I'm not going to do it right now, but if I were to pull up, say, just a short stock, well, maybe we'll do that in a sec. Remember that, $871. I'm going to send that order. Okay, we just sent that filled. If I were just to look to short Merck, our buying power effect there, $4,500 on that, right? Plus it has that unlimited, it doesn't tell us the potential loss, but it is that theoretical unlimited loss in that case. So we're not going to do that one. Let me get rid of that. Okay, so there we go. That's something I'd encourage. Practice paper money. That's why we have paper money, is so you can practice. Here's some other trades I was looking at here. In terms of back ratio spreads, you come up with your own. These aren't recommendations, but these are just if you're thinking of something. I was thinking of BMY as something we could demonstrate on. Maybe not. I think I already showed you that one. GE as something that maybe looked a little bit more on the bullish side, potential bounce here after a good run up, consolidation, kind of a flaggy pattern on GE. If you wanted to practice a back ratio spread on that. Intel Intel, kind of the same thing. Maybe you're waiting for a little bit more of a bounce here on this, but Intel, after like years of struggling, actually maybe looks like it's seen some brighter days here on that. And let me just see if I jotted some more down just in case, but I don't want to, I don't have time to do a full another trade here. How do you do Mondelez? It's Mondelez. MDLZ? Yeah, that's what I thought. Okay. Trend was down, down, down on this. It looks like that trend's reversing though. We're above our moving averages. Our stock is, the moving averages are sloping up, and we had a nice little bounce there on that. So practice a back ratio spread on paper money on Mondelez. All right, everybody? Hey, thanks for joining me today. I want to thank Barb for helping me out in the chat. Of course, as always, coming up next, we have ThinkScript studies. That's a great class, by the way. And also, let me mention this. For those of you around the country who are interested, we put on some live workshops around the country, live classes around the country. Okay, these are typically 2-day events. And Barb is going to be out on the road more and more this year. Okay, and so you will, if you want to see Barb in person, make sure you check out some of those live events there. And I'm excited for her because she's a great face of the company, so to speak. And I'm glad she's going to be out there. But anyway, thanks for joining me, everybody. Thanks, Andrew, for helping me out in production. And we'll see you all same time next week. Bye-bye, everybody. Oh, remember the survey link.